The Rebel Capitalist Show.
What are your thoughts on what's going on around the world, and how should investors be looking at this?
Yeah, well, I mean, first of all, I have to say, what's going on in Ukraine is tragic when you look into it, and I almost feel, bad talking about markets in the midst of all this thing. I mean, we have to have some perspective that some lives are being destroyed, and I have a great deal of sympathy for that. My son is stationed in the Air Force on a nuclear air base in Europe, so. I'm, as I guess involved or as paying as close attention to the situation as anybody. Trying to, but at the same time, markets are my business, and you have to, you can't just decide to not pay attention to this stuff, and you have to be able to look at these things, keep your head, and be able to react. And when the Russian stock market crashed, I love panic. Whenever you see panic in the markets, it grabs my attention. And so I looked at that as this is a really interesting opportunity to buy into panic, because normally when you can do that, that's when you find that some of the best long-term opportunities in the markets.
Right.
And so, Wednesday started buying up some of these, Russian stocks, because at 2 to 3 times earnings, it's incredibly cheap.
Yep.
Yeah, to me, it seems like there's a margin of safety there, and you're getting paid to take the risk, the risks that are out there, and one of those risks is that the market doesn't trade again for a long time. I mean, they closed the Russian stock market in 1917. I think I saw somebody tweeting it didn't reopen again for 75 years. So there is, there are risks out there that these things can that are major. But when you look at it, panic selling and incredibly depressed valuations, to me it looked like an interesting opportunity. But after I put the trade on, I never felt comfortable with it, and I ended up just closing out the trade at a loss, but pretty quickly. So we can talk about it if you like. I really do think
let's go through the psychological components there, because the more I understand, and the more I talk to experts and professionals like you and other hedge fund managers and bond traders, and then going back to conversations we've had in the past about the Market Wizards books, the more I realize that probably the biggest part of being successful as an investor or a trader is all psychological.
Yeah,
it's just getting out of your own way, and then risk management, and then it's about controlling your emotions and knowing when to buy and when to sell. And it's easy to say ride your winners and cut your losers, but that's a lot different when you're trying to do that under extreme amount of pressure, not just as a hedge fund manager managing billions of dollars, but probably even more pressure when it's you managing your own life savings. So walk us through the emotions and the thought process.
Yeah, I can compare this to trades that I've made in the past. During the Deepwater Horizon spill, I stepped in and started buying BP stock in massive size for my own personal account and for accounts that I was managing at the time, because I had a really good belief in what the intrinsic value of those shares were, and I had a lot of confidence in that. And so essentially, if I remember the numbers correctly, this was a decade ago, a little over, the stock got absolutely crushed to the point where it was trading, below tangible book value, and essentially, I think they were estimating the worst case scenario for the company was going to be something like $30 billion in costs over a 10-20 year period for cleanup and liabilities and all those things. And when you looked at it, the company was generating cash flow of $30 billion a year. So there was no way. The stock was trading as if the company was going bankrupt. It was going to be gone forever.
Yeah.
And you could step in and buy the stock, because even in the worst case scenario, you maybe wipe out 1 year worth of cash flow. And so, I've had this experience of buying into panic many, many times in the past. BP was just, one example came to the top of my head. What I do think, you'll find, and I'm glad you mentioned the Market Wizards books, that these are some, I think you can read just the first 2 books are fantastic. And you'll have maybe 40 different traders that Jack Schwager, profiles in these books. And every guy has a totally different way of making money in the markets. But what they all have in common is they are all very good at taking losses, at recognizing. And so, you go, well, how do you know when to take a loss? Like, because I started buying BP and it kept going down, for a little while before it rebounded. And so how do you know when to take that loss? And for me, I just didn't have that confidence in the intrinsic value of the Russian shares. I mean, there's a possibility that they go to zero, and I don't have the expertise to assess all of those potential risks. So I think if you look at it like a lottery ticket, that's different than looking at it as an investment. If you look at it like, I'm going to buy this and forget about it, and in 5 years' time, it may have done something great or it may have gone to zero, that's fine. But I think if you're buying it thinking that there's a margin of safety somewhere that protects your downside, that there's a high probability it won't go to zero, then I don't have the ability to make that assessment. And so, for me, I think the decision to take the loss is when I recognize I've made a mistake. I've moved out into an area that is beyond my level of expertise, my comfort level, and I feel like I've made a mistake. And one of my favorite Jesse Livermore quotes is, whenever you found you made you're wrong in the markets, the only thing is to do is to be right. And that's by stop being wrong. So that's, cut your losses quickly, get out of the trade. And so for me, I felt like this was a mistake. I'm wrong here, get out and move on.
Yeah, because that's really the key factor, is it's knowing when you're selling for the right reasons, and then when you're selling for the wrong reasons. Because it takes me back to Jim Rogers, and I've had several conversations with him, and I explored one of the famous trades that he discussed, in fact, in Market Wizards, and that was shorting gold back in the late 1970s or 1980. And he said when he shorted gold, that it went way up like the next day or two. And I mean, way up. And so, I'm trying to understand, how was that not a time when Jim should have taken losses right there? Because your first loss is your best loss, and you want to manage that risk. But then there's times when it is more prudent to continue to hold the position. And I guess it goes back to what you're saying in your confidence, in your ability to analyze the situation to some degree of confidence.
Yeah, I think that's exactly it. I think, it comes back to your experience. And I've had experiences of buying into panic that worked out, and I've had experiences buying into panic or shorting things that I think are euphoric, and them working out or not working out. And I think it's, a big part of, investing and trading is, I think a lot of people say, to be successful, you need to learn how to disregard your emotions. And I think you need to learn how to just analyze them and appreciate them and understand them. And you get to know those feelings, that feeling of I'm buying into panic, but I know this is going to work, versus the feeling I'm buying into panic. And the last time I felt this way, it didn't work out very well for me. It actually continued going down. And so I think for me, it is a lot of that. It is that, and this is, I think, maybe the important point, is we all, as traders or investors, you come up with a thesis, and then you put that thesis into a trade. And, those are 2 separate processes, right? And so you have to have a process for your thesis, whatever that's, you're a fundamental investor or you're trading, you're trying to look for reversals in trading or what have you. And then when you put that trade into practice, you have to have a discipline for being able to manage that trade. So there's multiple levels of things that have to happen here. It was interesting. I talked with Julian Brigden about this over the last summer, how he comes up with a thesis of trading currencies. He was, I think, talking about the dollar index at the time. And then he waits and applies a trading discipline to that thesis. And I think that's really critical, is to, be able to separate the thesis from the trading discipline. And I think in Jim's case, and I'm a huge fan of Jim Rogers. He's, his chapter in Market Wizards is brilliant.
Yeah.
But I think in his case, he has a great deal of experience in trading those reversals. And I think he probably had a great deal of confidence in the fact that what we were seeing in gold in the early 80s was an absolute blow off top. That you had, I think he's even said, I think, in that book, whenever you go against panic, and I know John Templeton has said this many times too, whenever you go against panic, odds are you're going to be right, over a certain time frame. And gold in the early 80s was panic buying. Absolute panic buying. It's the kind of the reverse of the panic selling we're seeing in
I call it hysteria. Hysteria buying, panic selling.
Yeah. So, I mean, you either have the fear of loss that causes people to sell, or you have like extreme fear of missing out that causes people to buy at the top. And so it's still fear that drives a lot of that. And so I think that's, Rogers is just a genius at that, looking at those fear trades in the market and taking the other side. And so I think it was his personal experience of shorting things like that in the past, and knowing, man, anytime a setup comes across your screen like this, you have to take advantage. And this is another point too that comes across in the Market Wizards books that I love, which is, if you just pretend you're not a trader, pretend you're not an investor, until an opportunity comes along that is so compelling, you have to take advantage of it, your batting percentage is going to go way, way up. And I think that's what Jim does.
Yeah.
I think he just kind of like pays attention to the markets. He doesn't feel like he has to trade all the time, but when something comes across his screen that's like, wow, this is unbelievable, I have to put a trade on. Those are the types of opportunities he's looking for to take advantage of.
Well, Jesse, remember what you do is you just sit there and wait, do nothing. And then all of a sudden, when a big pile of money shows up in the corner, all you do is go pick it up.
Exactly right. Exactly right.
And for those of you who haven't read the Market Wizards book, I'm paraphrasing a quote from Jim in the book. Is what his investment strategy is.
Absolutely right. Yeah. You nailed the quote. I kind of paraphrased it in my own long-winded fashion.